As the sun sets on a bustling city, the streets are filled with the hustle and bustle of people, their lives entwined with the ever-evolving global economy. Yet, amidst the skyscrapers and neon lights, there lurk stories of economic crises that have shaped our world. Stories filled with hidden causes, cover-ups, and unexplained events. Join us on a journey through the murky depths of financial history as we unravel the unsolved economic mysteries behind these collapses. Our story begins in the 1930s, a time when the world was plunged into an economic abyss known as the Great Depression. This dark period consumed jobs, dreams, and hope, casting a shadow over society. Beneath the surface, the mystery of what truly caused this catastrophic event still remains. Was it the infamous stock market crash of 1929? Or were there other, more hidden factors at play? The stock market crash, also known as Black Tuesday, is often cited as the spark that ignited the Great Depression. Investors lost faith in the market, leading to a downward spiral that wiped out fortunes and crippled businesses. However, some argue that the crash was merely a symptom of deeper issues within the global economy. One such theory points to the reckless actions of central banks, particularly the Federal Reserve. In the 1920s, the Fed implemented a series of policies to curb inflation and encourage investment, inadvertently fueling an unsustainable economic boom. When the bubble burst, the Fed's failure to act decisively and provide adequate liquidity only exacerbated the crisis. Critics argue that these missteps were the true drivers behind the Great Depression. Another perspective highlights the lack of international cooperation as a contributing factor. In the wake of World War I, many nations faced economic hardships, and protectionist policies began to take hold. Countries like the United States implemented high tariffs, hindering global trade and stifling economic growth. This toxic environment created a domino effect that ultimately led to the Great Depression. The gold standard, which tied currencies to the value of gold, also played a role in the crisis. Countries adhering to the gold standard found themselves with limited flexibility in managing their economies. As the Depression worsened, some nations abandoned the gold standard in hopes of stimulating growth, causing further instability in the international monetary system. As we delve deeper into the mystery of the Great Depression, it becomes clear that this catastrophic event was not the result of a single cause, but rather a complex interplay of economic forces. The stock market crash, central bank policies, lack of international cooperation, and the gold standard all contributed to the perfect storm that was the Great Depression. By unraveling this enigma, we gain valuable insights into the vulnerabilities of our economic systems and the importance of vigilance and cooperation in safeguarding our collective prosperity. As we emerge from the enigmatic realm of the Great Depression, we fast forward through time, traversing decades of economic ups and downs to land in the 21st century. Here, we encounter yet another seismic event that shook the very foundations of the global economy, the 2008 global financial crisis. With lessons learned from the past still fresh in our minds, we continue our investigation, seeking to uncover the intricate web of hidden forces that contributed to this modern-day economic catastrophe. The world was once again shaken in 2008, as the global financial crisis sent shockwaves through markets and economies. At the epicenter of the crisis lay the subprime mortgage bubble, fueled by reckless lending and an insatiable appetite for risk. However, as we dig deeper, we discover that there were darker forces at work, exacerbating the situation and leaving a trail of devastation in their wake. One such hidden force was the proliferation of complex financial instruments, like mortgage-backed securities, MBS, and collateralized debt obligations, CDO. These instruments bundled together mortgages, including the risky subprime loans, and sold them to investors as seemingly safe assets. As the housing market continued to boom, demand for these high-yield investments soared, further fueling the subprime mortgage bubble. However, when the housing market eventually crumbled, the true value of these complex financial instruments was exposed. Defaults on subprime mortgages skyrocketed, and the value of MBSs and CDOs plummeted, causing massive losses for investors and financial institutions. The collapse of these instruments played a significant role in the near collapse of several major banks and investment firms. Another hidden factor was the lack of regulation and oversight in the financial industry. financial institutions were allowed to engage in risky lending practices, often with little capital to absorb potential losses. Regulatory bodies failed to recognize the growing threat posed by the subprime mortgage bubble and the complex financial instruments associated with it. As a result, when the bubble finally burst, the financial system was ill-prepared to handle the fallout. The role of credit rating agencies in the crisis cannot be overlooked either. These agencies often gave top ratings to risky financial products, like MBSs and CDOs, giving investors a false sense of security. Conflicts of interest and a lack of transparency further muddied the waters, contributing to the eventual collapse. The 2008 global financial crisis was a result of a tangled web of factors beyond the subprime mortgage bubble. The proliferation of complex financial instruments, lack of regulation, and the role of credit rating agencies were all hidden forces that exacerbated the crisis. By uncovering these dark secrets, we gain valuable insights into the vulnerabilities of our financial system and can strive to create a more stable and transparent economic landscape. As we delve further into the complexities of the financial world, we arrive in the digital age, where technology has become an essential part of our financial landscape. With innovation comes new challenges, as evidenced by the flash crash of 2010. In a matter of minutes, the stock market plunged and then recovered, leaving experts baffled and searching for answers. Was it a technical glitch, or were there unseen forces manipulating the markets? Theories abound, but the truth remains elusive. One theory suggests that high-frequency trading, HFT, a practice where algorithms rapidly execute trades in milliseconds, played a significant role in the flash crash. HFT firms aim to exploit tiny price discrepancies and market inefficiencies, often making numerous trades in the blink of an eye. While HFT can provide liquidity and efficiency to markets, it can also create instability. In the case of the flash crash, it's believed that an unusually large trade executed by an HFT algorithm triggered a cascade of sell orders, causing the market to plummet. Another hypothesis revolves around the role of market fragmentation. With the rise of electronic trading, multiple trading venues have emerged, fragmenting the market and making it more complex. This fragmentation may have contributed to the flash crash by disrupting the normal flow of liquidity and exacerbating price fluctuations. When the initial drop occurred, the fragmented market structure could have hindered the ability of buyers and sellers to find each other, amplifying the crash. Some experts also point to the potential impact of a fat finger error, where a trader inadvertently enters an incorrect trade due to a typo or a miscommunication. While this theory is less likely, given the rapid recovery of the market, it still highlights the vulnerability of our increasingly interconnected financial system to human error. Despite various investigations, the true cause of the flash crash remains uncertain. However, the event serves as a cautionary tale, emphasizing the need for greater transparency, oversight, and regulation in our ever-evolving financial markets. By examining the mysteries of the flash crash, we not only gain a better understanding of the challenges that come with technological innovation, but also learn valuable lessons to prevent future market disruptions and safeguard the stability of our financial system. If you've made it this far, I want to thank you for watching. Don't forget to give the video a like and subscribe to the channel for more videos like this. See you in the next one.